application of manufacturing overhead. So we calculate the predetermined overhead rate before the period begins, right? So as we work on particular job, we apply overhead by multiplying the predetermined rate times the actual activity. So basically what this tells about in plain language, for example, we estimated that we will be applying 20,000 direct labor hours, but it turned out to be that we applied actually 21,000. So it means the predetermined overhead rate was based on 20,000 direct labor hours, and your actual direct labor hours were 21,000. So it means the predetermined overhead rate cannot be compared with the actual one. Why? Because you need to compare apple to apple. So one rate is based on 20,000 and the actual one should be based on 21,000. So that estimated manufacturing overhead that you estimated, that was based on 20,000. So basically now you clarify in step 2 that what would be our estimated manufacturing overhead if we had applied it or on the estimated of 21,000. In that way you can compare apple to apple. So here is the formula. Number 1, you calculate POHR and then you multiply with the actual activity, right? So basically this actual activity is the amount of allocation is based upon the actual level of activity. So this is also called a normal costing system, right? So you estimate the cost in advance before the job is done, and at the end of the job you compare your estimation with the actual one. If your actual one is lower or greater, so you will compare it with your estimated one, that what was the cost driver we used. If your cost drivers is actual one is exactly 20,000, then there is no need to re-estimate your estimated manufacturing overhead, because your estimated activity 20,000 direct labor hours is exactly equals to the actual direct labor hours of 20,000. But the problem arrive when you use greater cost driver or direct labor hours. So in that case you cannot compare the estimated manufacturing overhead. Why? Because that estimated manufacturing overhead is based on estimated direct labor hours that you estimated in the beginning. So it should be compared with the actual one, 21,000. So that's why you are multiplying the POHR with the actual activity. So here, recall our equation for the calculating predetermined manufacturing overhead rate. So for peer co, which we talk about in our earlier slides, that the overhead is allocated based on direct labor hours. So if the estimated manufacturing overhead for the coming period is $640,000 and the peer co estimated 160,000 direct labor hours, then POHR would be $4 per direct labor hours. So now how this predetermined overhead rate is applied on our job cost sheet. So recall that an employee worked a total of 8 hours on a job that is A143. So our predetermined rate is 4 that we calculate in our just previous slide. So we will apply $32 in our manufacturing overhead. So this computation is also shown in the manufacturing overhead section of a job cost sheet and also in the summary as well. So this amount come here, right? So now in this way we have calculated our manufacturing cost, that is direct labor plus direct material plus manufacturing overhead, right? And in that way, if we just add it here, that would be our total cost, total manufacturing cost. And since how many units are completed? 2. So we divide 236 divided by 2. Answer would be 118. So our unit cost is $118 per crate. So I have also pasted exercise 3.5 from your book 121. So to further clarify your concept regarding this predetermined overhead rate, so let's try to solve it together. So first I'm going to give you 5 minutes to read the question, to digest the information here, and then we're going to solve it together. So just pause it for 5 minutes and read it by yourself. Okay, let's do it together. Let's first read the question. So Luthan company uses a predetermined overhead rate based on direct labor hours. So our cost driver is direct labor hours. So there was 11,000 estimated direct labor hours and $257,400 of estimated total manufacturing overhead. So the company incurred actual total manufacturing cost of 249,000 and 10,800 total direct labor hours during the period. So you are required to determine the amount of manufacturing overhead that would be applied to the unit of product to the units of product during the period. So let's solve it together. What was the number one step? The first step is that we need to calculate POHR, predetermined overhead rate. Since the predetermined overhead rate is based on direct labor hours, so what is the estimated amount of total manufacturing cost? That is 257,400. And what is our estimated direct labor hours? 11,000. And the answer would be here $23.40 per direct labor hour. And now how much amount of manufacturing overhead would be used if we used 10,800 direct labor hours? So you just multiply the POHR 23.40 multiplied by 10,800, and that answer would be 252,720. So had we estimated that we would be using 10,800 direct labor hours, we would be estimating $252,720 instead of this $257,400 as an estimated total manufacturing overhead. So let's interpret the average unit cost. So we cannot say that the average cost per crate in future will be like the exactly $188. So if a third crate was to be produced, so it would not add some kind of fixed cost because it is fixed and we are not adding it. So when dividing the overhead cost with the number of units as well, so it will be someone less than $118. So average cost is basically decline when there are more number of units produced.